Thank you for joining me for the second video of the series dedicated to all things retail investors know for sure that just ain't so. In this video, we're going to be looking closely at the notion that bonds are safer investments than stocks. This is a very important video because what I'm about to reveal to you right now is overlooked not just by retail investors, but by many professionals as well. Historically, bonds have undoubtedly been the go-to safe haven for investors to shelter themselves from market volatility in times of crisis. I will demonstrate why, given the current economic conditions, the bond market has evolved into somewhat of a ticking time bomb. A time bomb set to maim those most prudent and vulnerable of investors who are simply seeking safety. This is what makes this crisis so heartbreaking, is the injustice of it. And for those of you who are curious about how bubbles are formed, paying attention to what I'm about to tell you is your front row seat to watching a bubble grow and inevitably burst like all other bubbles before it. But it's not all doom and gloom. There is a silver lining. So pay attention, hit like, subscribe, and make sure you're not making this investment mistake and you don't find yourself with the majority in times of crisis. If we look through the offerings of any bank or investment manager, we will inevitably come across a suite of professionally managed solutions conveniently designed for the client to choose their risk tolerance level. Now look at how risk is added or taken away from amongst these families of portfolios. Look past all the fancy names and jargon, and the underlying holdings can generally be divided into two categories, stocks and bonds. You see, on the risky end, portfolios are predominantly made up of stocks. Whereas for ultimate safety, a client is steered towards loading up his portfolio with bonds. The notion that bonds are safer than stocks is so central to not only modern portfolio theory, but also securities law and compliance, you can't get away from it. Over the last few decades, it's crystallized into almost a religious dogma that can't be questioned without raising eyebrows in the financial circles. Our whole system is built on this notion, with the crown of the safest asset going to the US Treasury bond. And because it's the safest, it's paying the least amount of interest, currently 0%. So let's review the case for bonds being safer. Bonds come in many different shapes and forms. There's government, municipal, federal, there's corporate, large cap, small cap, even junk. What they all have in common is they're all essentially IOUs for borrowed money, promising to pay a specified interest rate and repay the principal upon maturity. One obvious concern for the bondholder is the creditor's ability to live up to his or her financial obligations, as in repay the interest and the principal in the agreed upon time frame. This is referred to as credit risk or default risk. But the risks don't stop there for the bondholder. The bondholder can lose money on their bonds with fluctuations in interest rates in the market. This risk is not so obvious to the naked eye, but it is important. So here's an example of how it works. An investor buys a US Treasury bond at a time when interest rates in the market are 5%. Having purchased this bond for $1,000, the investor is now entitled to a fixed cash flow that will not change as interest rates in the markets change. The creditor continues to pay the bondholder at the agreed upon terms, 5% interest and a return of principal upon maturity. But not every bondholder is committed to holding their bond till maturity. To cash out, the bondholder may need to sell the bond, which brings them back to the market and the market interest rate. If interest rates in the market rise to, let's say, 8%, our coupon bond paying 5% now appears less attractive. To sell the bond, the investor will have to price it at today's rate in the market, and will be forced to sell his bond at a discount. On the other hand, if market rates come down to 3%, now our 5% coupon bond is looking more attractive, and priced at the current market rate, the investor can sell his bond at a premium. Notice the bonds have an inverse relationship to market interest rates, meaning when interest rates go up, bonds go down. If interest rates go down, bond values go up. Other than default risk and interest rate risk, there really isn't much more to bonds. Those are the only variables that we need to know to predict with 100% certainty what the price of any bond is going to be at any time. Now let's contrast that with stocks. Stock investors too are obviously exposed to interest rate risk and default risk, but they're exposed to many more risks as well. The cash flows of a stock investor are far less predictable than a bond. And I just want to highlight that even though both stocks and bonds are exposed to interest rate risk, the degree, the effects, and the sensitivity varies amongst asset classes. And what I mean by that is a rise in interest rates will affect stocks in many different ways, depending on how the individual stock's business is structured, how much debt they have, how much debt they need, and a whole host of other factors. But going back to bonds, things are very straightforward, very predictable. There's no room for surprises or black swan events or anything like that. It just comes down to simple arithmetic and the time value of money. Rates rise, bonds fall. Rates fall, bonds rise. So now we begin to see the logic of why bonds are deemed safer. It is because they're exposed to substantially less number of risks, only 2, as opposed to an unlimited number for a stock investor. So far, bonds sound like a prudent investment. And given that historically many people have financed their whole retirement in bonds, there seemingly is no reason to doubt the safety of bonds. But that just ain't so. It's when we drill down deeper, modeling real-world numbers from today's markets, that many are surprised to learn what kind of performance they can expect from their safe conservative portfolio of bonds. So pay attention, because you don't want to be surprised the expensive way. And as I said, there's still time to fix this. When we look at today's world of interest rates, we see that central banks, having kept rates low since the '08 crisis, have pretty much stayed at those low levels in the United States, and even invented something called the negative yield bond over in Europe and Asia. To clarify, you heard it right, you can invest in a bond that you pay interest to. And if you're watching and you own one of these bad boys, please leave a comment and explain why you would own such a thing. Just think about that for a second. Paying somebody to borrow your money. Good luck trying to beat inflation with that stellar investment strategy. Reviewing historical charts of interest rates, we quickly see that low rate levels like these are not normal. In fact, we haven't had rates this low for thousands of years. I can't overstate enough what an outlier this period of time is for interest rates. You can easily find charts on the internet that compile data on interest rates accumulated over centuries, and you can judge for yourself what a normal interest rate is. And trust me, the answer is far from 0 or some negative number. 6 to 8% interest rates in the market are normal. That's not high. High interest rates is when interest rates are well into the double digits, like they were in the 80s. Generally in nature, when something hits a limit, things start reverting back to the mean, not continue going off the charts into perpetuity. Now, many among us cling to the hope that this time is different, and the world is ready to take a dive into the uncharted waters of keeping interest rates low, or maybe even plunging into negative interest rates. And we will live happily ever after in this wonderful, utopian, fair, equal, and just society, with nothing but rainbows and unicorns. This certainly sounds appealing for a lot of reasons. However, many of us learned the "this time is different" lesson already, and are not falling for it a second time. But as the saying goes, a sucker is born every minute. I know, because I was one before I learned my lesson. So I really hope this video helps you avoid being suckered into believing some fairy tale, rainbow and unicorn vision of the future. What I'm saying is it's highly unlikely, unfeasible, and unrealistic to expect us to go into a world where investors now pay someone to borrow their money. It's as simple as that. So if a bond investor expects to earn anything more in their portfolio than the coupon, they're essentially betting that interest rates will never go back to normal and just stay at these low levels. Paraphrase, they're essentially saying something along the lines of, nah, it'll be fine. Who cares if it's theoretically impossible or it's never been done before? We're in 2020. Things are going to be great. Now, just give me some of these negative yielding bonds. Take a pragmatic look at this. I'm sure many of us would love the opportunity to borrow money at low rates, let alone get paid for borrowing money. But it takes two to tango. You need a lender to make this happen. There's got to be something in it for them. And how do we attract investors to a market where they have no hope of earning a return? Do we now mandate that everybody participate in this market? Does the government take over part of your pension plan and invest 30% of your assets into some nice negative yielding bonds? For your own safety, of course. That's like putting a tax on savers. What do you think that will accomplish? Or maybe the government can just print endless amounts of money to keep injecting into this market while we borrow to consume into perpetuity. So then, who's going to do the work to make sure that we're still productive and we have stuff to consume? The magical unicorns? I want to be the guy getting paid to borrow money, and I'm sure everyone else is too. The point that I'm trying to make is that you cannot have a functioning free market with zero, let alone negative interest rates. Investors deserve and will demand a meaningful rate of return on their money. So now let's look at what performance we can expect from our nice, safe Treasury bill bond paying 0.5% coupon. Retail investors and professionals obviously don't expect a lot of volatility from bonds. In fact, historically, investors sheltered themselves from the volatility of the stock markets in the bond market. But check this out, something very interesting happens when we're at these super low interest rates. Just look at how volatile these things become with the smallest of moves in interest rate. So for those speculating on negative interest rates, you could see a whopping 16% return if rates come down to a negative 1 percentage point. So there's certainly hope for the investor to beat inflation with this investment. Now, before you get all excited about the 16% return, don't forget about the time value of money. So if it takes 4 years for interest rates to get to negative 1, then it'll take you 4 years to earn that 16%, which works out to earning about 3.9% a year. Enough to beat inflation, hopefully, but certainly nothing to brag about. And this is the best case scenario. If rates don't go down to below zero, then the investor just earns the coupon, the 0.5%. Even with inflation at 3% compounded over years, that adds up to quite a bit of a loss of purchasing power. But of course it gets worse. If interest rates in the market come back to, let's say, 2.5%, which is still meaninglessly low levels, just a small move of 2 percentage points away from where we are right now, the value of our bond plummets by 18%. Now, if we come back to normal low levels of interest at, let's say, 5%, the bondholder gets a 35% haircut. And if we're actually returned to normal rates of around 8%, the bondholder is looking at losses of 50%. So you get the idea. You can imagine what can happen if interest rates actually go back to being high or in the double digits. So I hope you can see now that making money in the bond market is really becoming a long shot with these low interest rates that we have. And the stakes are high. The downside risk can be over 50%. Risking the chance of double-digit losses while betting on something unprecedented to happen for the world to go into a sustained period of negative interest rate does not sound like a safe bet. It sounds more speculative, if anything. So ironically enough, investors who choose that safest investment option in the profile are actually signing themselves up for a speculative bet on the interest rate market with not a lot of upside and a hell of a lot of downside. A big reason for this ridiculous volatility is obviously the fact that rates are low, so any change now produces a huge percentage change in the variable. What I mean by that is when interest rates are at a normal level, let's say 6 to 8%, a 2 percentage move in interest rates can be about a 20 or 30% variation in the variable. But when you're going from 0.25 to 2.25, that same 2 percentage move in interest rates now translates to an 800% change in the variable. So at these microscopically low rate levels that we're in right now, bonds are beginning to behave with more volatility than they ever had in history. This is what catches even professionals off guard. They just don't expect volatility from this asset class. The good news is that there is time to fix this if you're exposed. Not only that, but because we now know that bond values and interest rates have an inverse relationship, we can conclude that bond values are currently at their historic highs if interest rates are at their historic lows. This presents you, the investor, with a phenomenal opportunity to sell the high. Don't forget the rule, you buy low, you sell high. So don't waste this opportunity. Review your investments. If everything we've talked about up until now did not make you skeptical about the safety of your conservative bond portfolio, let's take a look at our 0.5% coupon bond from the perspective of a stock investor. Stock investors commonly find safety in value stocks, or in other words, stocks that trade at low price earnings multiples. Stocks with high price-earnings ratios are perceived to be risky bets by value investors. Therefore, they're extremely cautious when they encounter a stock with a high price-earnings multiple. This is an approach championed by Warren Buffett as well as countless other successful long-term investors and academics. So what would they have to say about our 0.5% coupon treasury bond? The price of $1,000 and coupon earnings of $5, we get a price-earnings ratio of 200. If rates drop to 0.25%, we're looking at a 400 times multiple. And if rates are zero, the price earnings formula breaks down because you can't divide by zero. Think about what that means. Your payback period essentially is over 200 years, maybe 400 years. To put this in perspective, let's see how this compares to the stock market. Prior to the 2008 market crash, where arguably the market was overvalued, the S&P 500 was trading at a max price earnings multiple of 60. Currently, in today's market, you can buy ExxonMobil, arguably a company with very little growth potential, but one that pays an 8% dividend nonetheless, and you can buy this at 15 times earnings. Or you can get a company like Adobe that doesn't pay a dividend, which is comparable to our 0.5% treasury bond coupon. However, it's only trading at 50 times earnings. Now, obviously, businesses like ExxonMobil and Adobe have the potential to grow their business and therefore grow their earnings. So I understand paying high multiples for a stock that has promising growth prospects. But a bond is not going to magically change its coupon. It's called a fixed income instrument for a reason. The payment date is fixed, the coupon is fixed. So from a value investor's point of view, a 200 times earnings multiple is certainly well into the overvalued territory, especially taking into the account that there's absolutely no hope of growth. Sometimes in markets, emotions like fear or greed drive investors to do things that seem silly, but only in hindsight. Like buying a piece of government paper that has no hope in hell of growing your money at price earnings multiples that make stocks prior to the '08 crisis look cheap. And all this because an investor is afraid to unexpectedly lose money in the stock market, so supposedly they're perfectly fine losing money slowly, expectedly, and surely in the bond market. Some refer to this seemingly irrational behavior as the formation of a bubble, a bond bubble. The key to having a good bubble, one that makes a really big historic pop, is to have everybody, every Tom, Dick, and Harry invest into one asset class, therefore pushing the valuations of that asset class through the roof into monumentally overvalued levels. As I've shown you from a price earnings perspective, bonds certainly qualify to be in overvalued territory. Now think about this. What is the most common investment choice of the average retail investor? That's right, you guessed it, it's the one in the middle, the one that's called balanced something or other. These balanced portfolios can have as much as 60% of their holdings invested in bonds. So in other words, 60% of the average portfolio is invested in paper that yields absolutely no interest, has very little upside exposure, and a lot of exposure on the downside, given today's economic conditions. The problem gets worse because due to a general lack of financial literacy amongst retail investors, many investors own bonds without even knowing that they own them. So don't be too quick to dismiss this and say, I'm not affected, I don't own bonds. Think again, how is your work pension plan allocated? What's in your retirement account at the bank? Sure, it's some professionally managed Bright Opportunities Infrastructure Fund. Doesn't sound like there's any bonds there. But take a closer look. What does the fund invest in? Does it lend out money in exchange for regular interest payments and a repayment of principal upon maturity? That sounds a lot like a bond, and it'll probably behave like a bond. What option did you choose on the investment portion of your life insurance policy? Was it the low-risk option? Well, 80% of that portfolio is now invested in bonds. Think back to anywhere where you had to make a choice of your risk tolerance, accompanied by all sorts of pie charts with varying proportions. Look there, and I'm confident you're going to find your stash of bonds. So do your due diligence before it's too late. Like I said, with rates low, there's never been a better time to get top dollar for your bond holdings in case you're earning them. And up until now, you probably made a really good return on them. So don't delay, review your investments while you still have time. Please leave a comment if you enjoyed this video and consider sharing it with those you care about, particularly those approaching retirement or maybe those in retirement already, as they are most at risk of inadvertently getting caught up in this bond bubble while simply seeking safety for their hard-earned assets in this economic lockdown. So I hope you find this video informative. As always, thank you for watching. I really hope you enjoyed it. Don't forget to like and subscribe, and I'll see you next time.